All right, guys, so in this lesson, we're going to do a practical journal review, meaning that we already looked at the data from the spreadsheet, the actual journal, but now we're going to be going trade by trade and breaking it down to see where the actual lessons are, where the actual improvements could be made, where is the fine-tuning that could be done, right? So to actually do that, you cannot do that from the spreadsheet, right? To get that type of information, the actual fine-tuning, the actual lessons, the mistakes, what was good, what was bad, you can only do that by going trade by trade now and digging into the screenshot. If you collect screenshots, great. If you don't collect screenshots, it will take you much longer to do, because then you have to go to your chart, go back in time, find the trade, analyze it. So I highly recommend that as you continue in your trading journey, your trading career, that you always take the screenshots of the final position, preferably higher time frame and the lower time frame, so that when you do your journal review, you can actually do it properly and efficiently. Because if you don't have the screenshots, it will literally take you at least 3 times more in the amount of time that it takes you to do a normal journal review, at least 3 times more, because you're gonna have to go to the charts, go back in time, draw in the position, which you don't know what it looks like. You can only figure that out by the spreadsheet, so take the screenshots, guys, after the positions close. It's going to help you guys a lot. And this type of journal review, what we have here, if you have a look at what's presenting right now, what I have put together is, whenever I do a journal review, I like to categorize it. It's the trades that were reviewed. And the thing is, you don't have to review every single position. So the trader that we're talking about had over 40 trades, right? I did not review 40 positions. The thing is, you do not have to review every single trade. Why? Because not every single trade is bad. Remember that. There's always going to be good trades where there's no changes, no improvements, nothing needs to be done, right? They are great. They might have failed. It doesn't mean that they're not good, right? Winning very good, perfect positions can be both winners and they can be both losers. So when you spot a trade that there's really not much there that you can pick up on, it's just a good setup, you don't have to review it. You don't have to spend your time collecting the information, writing down the notes, looking at the screenshots and so on, right? But again, you still have to look at every single trade. And when you're looking at every single trade, at that point you decide, well, I can't find anything here, moving on, right? But the one thing that I say is that when you're doing this journal review, I will suggest a couple things. Suggestion number 1, you do this type of journal review once a quarter, once every 6 months, once a year minimum. If you do it once a year, it's going to take you a long time to do it. If you do it once every 6 months, to review 6 months worth of trades, you're probably looking at anywhere from 3 to 6 hours worth of time. If you're doing this quarterly, you can probably review all your positions within a couple hours, right? And if you're doing it quarterly, then pretty much like Q1 finishes, you look at all your positions from Q1, you do your review, you find the major lessons, you do take the rough notes, and then you can move on into the next quarter, already implementing the lessons that you have learned from the previous quarter, and you're fine-tuning any adjustments. You can make them to your trading plan right at that point, rather than waiting 6 months or waiting a year, right? And the thing is, the difference of doing it like this, I still recommend journaling every single month, journaling weekly, so that you don't have to be putting the actual data collection, you don't have to be doing the data collection at the end of the quarter. The data collection should be done when the trade closes, either weekly or monthly, latest, right? But that journal review process, when you actually spend time in reviewing your entire journal, there's a difference doing that at the end of the month, which I think you should do anyway. But there's a difference doing it later and reviewing the whole bulk all at once. The reason being is, when you do the bulk trades all at once, like 1 quarter or half a year or the entire year at once, what all of a sudden will happen is all those lessons, they will be right at the top of your mind, right? Because if you're reviewing a trade, like if you're doing your review only monthly, here's the difference. If you're doing your review only monthly, let's say in January, you have one trade with potential lesson, higher time for momentum, it was accelerating, I took the trade long, potentially shouldn't have, right? Because the higher time frames were accelerating so much that I was catching the falling knife without enough confluence, period. You made that lesson in January, and then February, maybe the lesson doesn't present itself, March, the lesson doesn't present itself, April doesn't present itself, and maybe it starts happening again and you forget about the lesson, right? And I find that happens a lot because I reviewed a lot of journals, and what I've noticed is a lot of times I'm reviewing a journal and all of a sudden the trader has said in their trade review, mistake here, I made the mistake, gonna learn from it, not gonna do it again. 3 months later, same mistake. 6 months later, same mistake. 9 months later, same mistake. The lesson's not being made, right? So I think it's important to you review your trades monthly, but again, reviewing it at the end of the quarter, now you can do a whole package. You can review large amount of trades, right? You can even do it yearly or every 6 months if you don't have enough trades within a quarter. Sometimes within a quarter you might only have 10, 15, 20 trades, so you might want to wait a year or half a year so that you can collect a larger number of trades at the same time. Because when you review a large collection of trades at the exact same time, right, then all those lessons are fresh. You start to see repeat patterns because you'll be reviewing January through to March, or January to June, right, or January to December. And we do it all in one day. And when you do it all in one day, all of a sudden you remember the lesson from January, you remember the lesson from March, you remember the lesson from July, right? Because it's all at the top of your head. You just reviewed the trade 10 minutes ago, or an hour ago, or 2 hours ago. So you remembered the lessons, and then you write them down and you have a list of major lessons that are recurring over and over and over again. And that is what we're looking for here. We're looking for not just one-offs, not one potential fix so that we can have a little rule. We're looking at recurring issues. Because if you notice something just once and it never happens again, I mean, chances are that's not a major lesson and you don't have to go deep into it if it just happens once. But if it keeps on happening over and over and over and over again, right? Doing this type of review every quarter or every 6 months or every year, you'll notice those patterns of the same lessons appearing over and over and over again. And then you know that is literally a lesson that you need to eliminate, and it's going to be black and white, no gray area there. So let's dig into it. What you can see here is, again, I have it organized pretty neatly. So at the end of a quarter or at the end of a year, you can put yourself a package, put together a package of the trades that were reviewed, right? And we're going to go one by one into them, to the major lessons that were learned and the adjustments that need to be made. This we'll review in the next lesson. In appendix, rough notes, this will also be reviewed in the next lesson, and so on. But for now, we're just going to be looking at the trade review. So let's start with that. We have a few trades here. We're probably not going to get into all of them, but I'm going to start at the top. Right, so dollar CAD long IBO-A from January 14th, close on January 15th for a loss. It was a 1% loss. And remember from the spreadsheet, from the initial lesson, this was the trade that had the stop loss of 0.618 Fibonacci retracement instead of 0.75. So if we make the screenshot a little bit larger, right, the stop loss here was at 0.618 instead of 0.75, so the trader got stopped out. Right? And you can see he got stopped out, and all of a sudden a 4-hour lotus is developing, right? So it doesn't mean that it was necessarily a bad trade, bad stop placement. But let's dig into it further. What are the nodes that I said? So IBO stop placement must be below 0.75 Fibonacci. So that's the first lesson that was identified. It was also identified within the data, the actual journal, the spreadsheet. Lesson number 2, or potential insight. These are not lessons yet. These are insights. Insight number 2, be cautious with sideways price action and only enter if you love the higher time frames. So check it out. Sideways price action, what I meant by that is on the 1-hour chart, right? You can see that on a 1-hour time frame, we had a double bottom, same thing on a 4-hour chart. Price popped beautifully to the upside, giving us a higher high on both 4-hour and 1-hour. So it's an IBO-A. But after we broke out, we went into literally 2 days worth of consolidation. It's not deceleration, it's consolidation. And my problem is, right, so this is what I said, be careful of consolidation, entering within consolidation. Typically, I want that consolidation to break, right, price action to break out of the consolidation, either to the downside or to the upside. But when it's consolidating, it is hard to say when the consolidation will finish until it actually breaks out in either direction. So that's what I meant, be careful of consolidation. Now, this consolidation, check it out on the 4-hour chart. At the time of entry, we had a low test on a 1-hour chart and a nice strong bullish engulfing, volume, 5-minute break, all good, right? But at the time of entry, the 4-hour chart, check it out. Bullish engulfing, nice strong bullish candle, and all of a sudden we're decelerating, doji, high test, another doji, right? So at the time of the entry, the 4-hour chart is actually making a lower high, or just pretty much potentially suggesting that it's going to drop a little bit farther to form a higher low, right? Because the trader here entered right within the consolidation looking to go long right after the 4-hour chart decelerated, made a high test on a doji. That to me is a potential trap, right? And in this case, it consolidated a little bit farther and stopped the trader out because the stop loss was at 0.618 and so on. Now, from a higher time frame point of view, it's pretty good, right? And we'll have a look at that in a second, but those are the major lessons, right? So IBO stop placement below 0.75, be cautious with sideways price action. That is the reason why. And if you can't take a 1-to-1 with a stop loss below 0.75, don't take the trade with a smaller stop loss, right? So if that's the reason, if you cannot take a proper 1-to-1 because you're looking to only take a 1-to-1 maybe up to the 4-hour 50, right? If you were looking to target the 4-hour 50, which probably lined up with the daily 50 EMA, right? Remember, we have deceleration. I mean, we have weekly chart is rejecting support plus the 20 EMA. Monthly chart is obviously bearish. The daily chart is also turning bearish, but potential bullish move off of support, just as we also have the 20 EMA and the weekly. We decelerated doji inside bar bullish low test. Good deceleration. So from a day trade point of view, in my opinion, lines up for a quick day trade. But that quick day trade means target at the 4-hour 50. So if you're having your stop loss at 0.75 and you're targeting the 4-hour 50 and you cannot get a 1-to-1 risk reward ratio, you don't take a trade, right? That's the thing that I would do. I would simply not take a trade because I cannot get a 1-to-1 reward risk ratio. The second option is you make your stop tighter so that your 1-to-1 profit is lower, right? But now when you tighten up your stop loss, like put it at 0.618 instead of 0.75, now you potentially risk getting stopped out for no reason on an IBO setup. So that's kind of what I meant by that lesson. So I hope those make sense, right? We're going to move on to the next position. But again, you can take a mental note of these lessons. These are just insights at this point, right? At this point, it's all an insight. They're not major lessons yet because major lessons are the ones that keep on repeating, right? These are just insights. This is trade number 1. Trade number 2, Euro Kiwi long ABO, January 16th. Get a couple lessons here. So lesson number 1, ABO was executed too early into the daily run and intraday trend development, right? So remember, this trader had a very low strike rate on ABOs, right? I believe it was about 45%. And I mentioned as one of the lessons that the strike rate can be increased. That's what I was talking about. So this is a potential example of that. And that was based just on the data collection from the journal, the actual raw data. So now when we're looking at the screenshot, the lessons here, right? The trade was executed too early. So let's confirm that. Yeah, here we go. Check it out. So when we look at the weekly time frame or just in general, check it out. Monthly chart, kind of weird. I mean, we're accelerating to the downside. We're rejecting the monthly 50 EMA at the same time, so we could continue going higher. But check it out. On the weekly chart, we have a perfect break and retest of the weekly 50 EMA with a beautiful bearish high test reversal. So where's the momentum? The momentum is on the weekly chart is definitely bearish, right? It's a perfect break and retest of the weekly 50 EMA, which has held as really good dynamic support and resistance, right? So, and really good candlestick formation, really good rejection. So obviously we're starting a potential bearish run on this weekly chart. So the trader is looking to take an advanced breakout to the upside as the weekly run is just beginning. So that's what I meant by, hey, check it out. This might be a little bit too early because the daily run is still just beginning, right? Check it out. On a daily chart, we consolidated here a little bit as the weekly chart formed that highest reversal, and then we started to accelerate, right? And sure, we hit a support zone. I mean, it could go much farther down to 1.66, which are these previous lows that you can see on the daily time from here, or the previous low right here, which is again 1.66. That could have been the potential another support level. So we're not really trading off of major support here to take this long pullback. So to me, this is not developed enough, because remember, when you're taking an advanced breakout, what you're looking for is for the run to be finished. And when the run finishes, that means the intraday trend is also coming to an end. And you got to be careful of higher time frame momentum, right? So let's go into these lessons a little bit farther. ABO was executed too early into the daily run, right? So weekly and the daily chart, not enough major support. The weekly chart just started a new bearish run, and that's what I was talking about. And the momentum is strong, meaning it's just beginning, it just started, and it's a good rejection, right? So the momentum is strong. And I have here, don't trade against strong momentum. That's the one risk, is do not trade against strong momentum, specifically if it's an advanced breakout, right? Advanced breakout, you're catching a falling knife, and if you're trading against strong momentum, a new run or big accelerating candles on a weekly chart, then that is when you are literally catching a falling knife, because the weekly chart is accelerating against you, right? And you're just looking to take that intraday pullback that may never happen. And when you're getting a descending triangle on a 1 hour chart, but the weekly chart is accelerating, guess what? A descending triangle is still a bearish continuation pattern. So the weekly chart is accelerating, it can't just continue going down. So to me, this is a major lesson right here. The weekly chart just started a new bearish run and the momentum is strong. Don't trade against strong momentum. So make sure you truly believe that the daily run pullback has come to an end. Don't just trade the 4 hour pullback, right? So the daily run or the daily pullback needs to come to an end. You strongly have to believe that. It cannot just be a 4 hour pullback. Trade the start of a new daily run pullback. The intraday will be developing a new trend instead. It's not just a 4 hour pullback. And we're going to have a look at the intraday in a second. So what we have here is this looks like a daily continuation play against a strong weekly. Daily continuation plays need the weekly in their favor. So this trader here, he was looking at this as mainly this bearish trend has come to an end on a daily chart, right? Now we broke out, made a higher high, and now potential higher low, and a daily continuation farther up because of this monthly bullish candle, right? Higher low on a daily chart and continue farther up. So that's what this trader was looking at, but you totally missed this potential trap on a weekly time frame, right? And last point, if this was a daily pullback, right? If this was a daily pullback, which I think it's, well, if this was a daily pullback, if you're trading a pullback ABO, make sure it is overextended, right? Similar size or greater to previous daily runs. So overextended, meaning whenever you're taking a daily pullback, you're looking for an overextended run, like in this case, right? An overextended run. And you can see this run here on a daily chart from October to November went on quite far. And you can see the weekly chart was accelerating until it stopped accelerating. And then had a slight little pullback off of that 1.66 level. That was probably an advanced breakout up to the 4 hour 15. That's about it. Formed maybe an ACB and continued farther down, right? So make sure whenever you're trading a daily pullback, it is overextended, it is sitting at a major level. Make sure you're not trading it right as the weekly chart is accelerating. So those are the lessons from this setup. When we look at the intraday chart real quick, real briefly, because I also mentioned it's underdeveloped, Well, we're looking for a wave 5 to finish. Wave 1 breakout, wave 2 pullback, wave 3 run. That's kind of how I see this 1 hour chart. I mean, yeah, double top, breakdown, pullback, run, right? We're starting to develop bullish MACD, but the wedge, see how this wedge is drawn? The wedge for an advanced breakout happens at the end of wave 5 on a 1 hour chart. The advanced breakout wave should be happening, or the triangle pattern, right, for the advanced breakout should be happening on the 1 hour chart at the end of wave 5, period. Not the whole trend. It shouldn't be the whole trend. The triangle should not be the whole trend. The triangle should be the last wave. That's it. So that's a good lesson. I hope that makes sense. Let's move on to the next one. Euro Azie, another ABO. So same notes as above, right? Same notes as above. We're looking to go long here on a daily time frame, right? But check out the monthly chart. Very, very bearish, rejecting all-time highs, big bearish engulfing, kind of big bearish high test, not an engulfing, but a high test. Weekly chart, double top, big bearish high test, and it's starting to accelerate. And the daily chart seems like it's decelerating, decent support, multiple rejections, 1, 2, 3, 4, this would be 5 in the recent times, so decent support, right? You're looking to go long here as a daily continuation, but you're against higher time frame momentum, right? So you're catching a falling knife. And that is my take on that. And from an intraday point of view, check it out. Same thing, right? The trend should have been kind of happening, the wedge, right, should be happening at the end here, which you kind of have it. But another issue here is, check it out, where this trade was entered, there's no low test, there's no reversal candlestick, it's just sideways consolidation. Here we have a bullish engulfing, so if anything, maybe here you could enter an advanced breakout. Higher time frames do not line up, so either way there's no trade for me because of the higher time frames. But if anything, maybe here, as we're getting this bullish engulfing, because we need, this is a must, we need a strong candlestick formation for an advanced breakout. It is a must, right? It's not something that would be nice to have. A strong reversal is a must, and that happened after the trade was taken. And however, the reason for, in my opinion, for this trade failing is because, again, higher time frames. It is way too early. You're trading, taking an advanced breakout against higher time frame momentum. Major lesson, right? So it's starting to occur. Hey, now guess what? We eliminated 2 losses for advanced breakout strategy, right? So what has happened there? The strike rate has just gone up, right? It's that simple. One rule, already 2 examples. Another ABO, dollar yen short ABO, and I have it here, not the best advanced breakout as we don't really have any deceleration on the daily or any deceleration within the intraday trend. No clear pattern, therefore it is too early. So let's have a look. Yeah, this one's kind of interesting too, right? Because this is more of a trend continuation. Monthly chart has a low test, so it's kind of hard to say because monthly chart's got a low test. Weekly chart, well, we rejected support with a big rejection, now we pulled back. But obviously we could just be rejecting the weekly 50 EMA and continue further down. Daily chart just kind of had like this, not much deceleration. I mean, after the trade was taken from the bearish engulfing, but that is after the trade was taken. You can check it out. It broke the daily 50 EMA, right? The support and resistance level is okay, right? Get the weekly 50 there, which is good, but we don't have any deceleration. So when we look at the lower time frames were good, pretty good. So let's dig into this a little bit farther. So from a higher time frame point of view, right? In my opinion, not the best because we don't really have any kind of deceleration on the higher time frames. So I think it's a little bit too early. However, great use of discretion. The higher time frame resistance was great. The 4-hour tweezer top was great. The 1-hour tweezer top was good, and a double top was great. So overall, there were great confluence factors here. We had the weekly 50, we had horizontal resistance, right? We had a good pullback. It is kind of with the daily and the weekly trend, right? Monthly is a little bit sketchy, but other than that, it's not bad, right? From a higher time frame point of view. But again, I think the higher time frames are okay. They're not perfect. I think they're just okay, right? So personally, it's kind of like an ABO that I would not really spot based on looking at these higher time frames. But I said great use of discretion, because that's important. It is not a perfect ABO, so it is a discretionary ABO because of the higher time frames. Now, when you look at the lower time frames, they're pretty good. I mean, the wedge, again, the wedge is not really ideal because it's not really a wedge on a 4-hour chart. Same thing on a 1-hour chart. It's not really a wedge. The wedge should not be drawn in based on that entire trend. It should just be something that is happening at the end. But tweezer top, great on a 4-hour chart. Distance to the 4-hour 50 EMA, that is enough. So good deceleration, good tweezer top. 1-hour chart had this slight double top. Then I had a tweezer, and that's where the trade was taken on a 5-minute breakdown as the volume was increasing. So from that point of view, I think the execution was good. I think the patience was good, right? The 4-hour tweezer was great. That's exactly what we want to see in an ABO. 1-hour reversals, that's exactly what we want to see in an ABO. A good, strong 5-minute breakdown, exactly what we want to see with an ABO as the volume increases. The wedge could be improved. The daily chart could be improved. Weekly chart is good. So that's why I said good use of discretion, because in the short term, tweezers on a 4-hour chart definitely suggesting a pullback, and the 1-hour chart definitely suggesting a pullback. Is it ideal? In my opinion, no. I think it's more of a discretionary advanced breakout. Right? So not really any kind of major lessons here. This is just some insights. All right, next trade up, and we're going to speed it up a little bit. Kiwi CAD short IBO-A. So we already looked at a few ABOs. Now let's have a look at some IBOs. So Kiwi CAD short IBO-A from February. So my notes, clean IBO-A execution, great job on the short-term prediction. However, quite aggressive due to the strong weekly bullish continuation pattern. Higher low for bullish engulfing. With that said, good call on the short-term day trade. Just understand that even though the lower time frame pattern is perfect, this is still a bit more aggressive. So check it out, higher time frame. Or let's have a look at the lower time frame first. Lower time frame. So lower time frame, good IBO. I mean, the 4-hour chart had major resistance. It had a double top at that major resistance with good acceleration to the downside. Then pull back, little high test, and that's when the trade was taken. Good 4-hour chart, really good 4-hour chart, right? This is an IBO-A. On a 1-hour time frame, we have this triangle pattern, a triple top, and a perfect breakdown, lower low. Beautiful retracement, forming a high test, bunch of deceleration, another high test, and then finally kind of a strong 5-minute breakdown, right? Trade could have potentially been executed a little bit earlier, but either way, good 1-hour chart, good IBO. It was a 1-to-1 targeting the 4-hour 50. Lower time frames are great, in my opinion. They are perfect. They don't need any fixing. They don't need any changes. The lower time frames are really good, right? Higher time frames, this is where it gets a little bit sketchy. Higher time frames, this was a short trade, but from a higher time frame point of view, the monthly chart is a little bit more bullish. The weekly chart just has this break and retest, rejecting the weekly 50 EMA with this bullish engulfing. So this bullish engulfing can force this higher up. Now from a daily point of view, good resistance area. It's kind of a range. It did decelerate here for 2 days, rejected with a doji and a bearish engulfing high test. So, I mean, from a daily perspective down, it is not bad. The daily chart is within a range. But this is what I meant by the risk, right? It's still aggressive because the lower time frames line up. The daily chart is okay. I mean, it has the resistance, it has the deceleration, it has the candlestick formation. But the weekly chart is fully against you, right? And it's just potentially starting a brand new run, potentially, right? With that bullish engulfing, rejecting that weekly 50. So this is what I meant, quite aggressive due to the strong weekly bullish continuation pattern. Higher low for bullish engulfing, right? With that said, good call on the short-term day trade, because that is exactly what you should be doing. If you're taking a position, it should not be down to the previous daily lows or any further down. It should only be a quick day trade because of that weekly time frame, right? But I also said, understand that even though the lower time frame pattern is perfect, it's still a little bit more aggressive. So if you want to be more on the conservative side, this is a trade to potentially avoid. But either way, good lower time frames, good one-to-one, good execution, a little bit more aggression, or it's a little bit more aggressive because of the weekly. Nothing major there. Next one, Euro Yen short IBO-B. The 4-hour was an ABC pullback without much deceleration on the daily. Note that this is a bit more aggressive. Okay, let's have a look. So an IBO-B. Let's read the notes a little bit farther. So great job on identifying that this is actually a short-term opportunity. Okay, good, right? A lot of people would potentially take a long-term trade, so good thing that this is a short-term opportunity, only taking it as a one-to-one. This matches a day trader personality. Avoid closing one-to-one trades on a 5-minute break, right? Let them play out. You don't want your average reward risk ratio to ever fall below 1.0. Hey, check it out. Here's that example, right? So based on the data collection, we noticed that, again, the average reward risk ratio per trade fell below 1%. I believe it was 0.9, right? So this is that example. It's when you start shutting down trades a little bit early, right? So your target pretty much should have almost been hit. Almost. I mean, if you're targeting the 4-hour 50, make it a practice to have your target just a little bit above that 4-hour 50, not right on it, a little bit above. That could potentially tap you out for profit, full 1% there, unless the target was actually below the 4-hour 50, which that would have been an error, right? Otherwise, from a 4-hour point of view, I mean, there's an IBO-B, but we did decelerate to form a lower high. The 1-hour chart, good breakdown, right? And it started to decelerate, good rejection in general, right? So that's not bad. The issue is, again, with the less than 1%. Because at this point, even like at this point still, the 4-hour chart was just accelerating. There was really no major reason to shut it down, because it's not like it rejected this level, right? It still had room to that area. So you could have just bulletproofed it, if anything. Bulletproof, let it run. That's kind of what you could do as well. Now, higher time frame analysis. This is kind of where it gets a little bit different. Monthly chart is bullish, weekly chart kind of hitting resistance, but accelerating. Daily time frame, not bad, it's a resistance. Slight little daily bearish engulfing. I mean, the higher time frames here are okay. There's nothing spectacular, they're just okay. Lower time frame is definitely an IBO there. So from an aggressive day trader, I mean, there is an IBO on a lower time frame, and there is a daily resistance level with a daily bearish engulfing, right? So that fits the strategy. We have daily resistance, daily bearish engulfing, 4-hour lower high, 1-hour IBO, right? So it fits. But obviously the higher time frame could be a little bit better. So I said the 4-hour was an ABC pullback without much deceleration on the daily. Note that this is a bit more aggressive, simply again because we didn't have any deceleration on that daily chart. 4-hour chart was an acceleration. So this is just like an ABC and a potential continuation further up, right? That's kind of what I meant by that. Great job on identifying that this is actually short-term opportunity and only taking it as a one-to-one. Good. So as a day trader, that is good. The issue comes in when people take okay higher time frames and stretch their targets, right? A lot of times if you have just a good daily rejection and everything okay on a lower time frame, for a day trader, a lot of times that is fine, but you need that good daily rejection, right? So good call for that one-to-one. Now avoid closing those one-to-one trades early, make sure that they actually play out, because you don't want to drop your average reward per trade below 1%. And only close one-to-one setup when they miss your target and break back above your entry price, right? So that was kind of a suggestion. It's not necessarily a rule. It's something to definitely keep at the back of your mind. But you can definitely make that a rule, right? So this right here, this can definitely be a rule, or it can just be a suggestion to keep in mind. So that's it for that setup. Aussie dollar long IBO-B. This one's interesting. So let's have a read at this. I have to disagree with your self-review here, as you're pointing out flaws that are not flaws. This happens a lot, right? I find that a lot of people potentially point out things that aren't really negative confluence factors, right? So let's dig into further. That is just a perception without taking into account your day trader personality, right? This guy is a day trader, remember that. So quote from the ASR by this trader. Overall, I believe this is a great setup, but I should have pushed it for more profit, okay? The weekly was forming a potential triple bottom, so it would have made sense to push it to the daily 50 EMA. If I would have targeted the daily 50 EMA, I could have targeted a reward risk ratio of 2.8 to 1. If I had done this, I would have bulletproof at break even once the 4-hour chart gave a strong break above the 50 EMA. And price did drop back down and would have just stopped my stop loss and taken me out for break even, right? So it would not be a 2.8 to 1, he would be stopped out for break even, right? Versus this was a 1% win. And that was an example of stretching a pullback. This is a daily pullback that was potentially being stretched, right? So in my opinion, that is an incorrect flaw that this trader potentially identified. Why? Because they are a day trader, right? They are a day trader looking for quick opportunities, and this is just a daily pullback. Sure, it has major support region, but it's just a daily pullback. You do not have to take this to the daily 50 EMA, and in my opinion, you shouldn't. It's a quick day trade, target the 4-hour 50, move on, right? Banked 1-to-1, really good job, in my opinion. Let's continue further. In my opinion, this was an ABO on the daily with a clean support, but no signs of bullish price action. So it's kind of an advanced breakout, not much of a pattern, kind of an advanced breakout, but I said not with no signs of bullish price action, right? So it's kind of an IBO, but no signs of bullish price action on a daily chart. There's no really wedge, there's nothing really developing there. A swing trader could have taken this farther due to that longer term personality, but it would also be nice to have bullish price action development on the daily in order to make that decision, right? So as I always say, as a swing trader, you're looking for a proper advanced breakout. You want to make sure you have enough of a pattern development, price action development to actually take the breakout and push it further, right? Due to the lack of bullish price action on the daily, a swing trader could also avoid this setup because you cannot get a good reward risk ratio. Hence why it was a good day trade. It was not a good swing trade because there's not enough of a pattern development, in my opinion, yet on a daily chart. It's just a pullback. And sure, if it broke out, then guess what? You have an IBO, right? But at this point, in my opinion, it's not enough development. So a day trade, in my opinion, was good. So if you wanted to take this further after realizing that this doesn't have bullish price action yet on the daily and as a breakout play, you could have done so utilizing the short-term aggressive management. That would match the day trader personality, period. Short-term aggressive management, right? So if this trader wanted to push it further, right? If they wanted to push it further, what they could have done is they could have drawn out their Fibonacci extension on a 1-hour chart. And this is an IBO. It's a head and shoulder pattern on a 4-hour chart, inverse head and shoulder pattern. It's an inverse head and shoulder pattern on a 1-hour. It is a good IBO, right? It's a good IBO. The entry could have been a little bit premature just because at that point you had that big bearish candle on a 4-hour chart. But either way, you would have entered after this 1-hour bullish engulfing either way, right? That happened a little bit after. So I think the IBO is good. I think the daily support is good. I think the setup is good. The note, right? The only note, that's what I meant by an incorrect flaw, right? Is that this trader, as a day trader, said he should have pushed it further more as a swing trade. When in that case, there's not enough higher time frame development. But if they wanted to, they could draw out Fibonacci extension on the 1-hour chart. This is a 1-hour wave 3 run. They could be targeting 1-hour 1.272 Fibonacci extension as an example, right? And manage it more aggressively with short-term aggressive management because it is a pullback. So if price looks like it's rejecting that 4-hour 50 EMA, he could have taken profit and shut it down manually. Otherwise, he could have broken that 4-hour 50, and at that point, he could maybe start trailing the 5-minute 50 a little bit closer, right? Totally different view. As a day trader, that's kind of how you could have approached it. Otherwise, this is the correct day trade. In my opinion, there's nothing wrong with the setup, right? This trader thinks there was. In my opinion, there is nothing wrong with the setup. It was perfect execution. It could have been executed differently if you have a little bit more of a different day trading personality, right? Where you're targeting like a 1-hour wave 3 run on IBOs at 1.272 Fibonacci extension, applying more of a short-term aggressive management approach. So good trade there, in my opinion, but a lot of notes, right? Because again, that's the kind of stuff that you can pick up. Azie Swiss short IBO-B. Let's have a look. April 22nd, this is more of an intraday range rather than a triangle breakout. If you see it as a range instead, we still didn't have a breakout. So this is more of an intraday range rather than a triangle breakout. If you see it as a range instead, we still didn't have a breakout. Okay, good, interesting. In general, lots of intraday indecision as seen on the 4-hour and by the 1-hour range. This confirms your own ASR of a weak 1-hour break and retest. So the trader pointed it out, it was good. But check it out. Notice how this trader is taking a lot of pullbacks already. I don't think we analyzed the run yet. This was all pullbacks, right? And something that I mentioned is one of the issues that this trader had is not enough CBOs, and issue number 2, reward risk ratio was low. Why? Not enough runs. Okay, not enough runs. A lot of 1-to-1s, a lot of 2-to-1s kind of thing, because a lot of pullbacks. So monthly chart obviously bullish, weekly chart obviously bullish because it just broke the weekly 50 EMA and is accelerating. Daily chart sitting at some minor resistance. All-time highs is a little bit higher here. So we have resistance, maybe it's a little bit stronger farther out. We decelerated, good. So we got resistance, we decelerated, quick pullback play. Obviously monthly, weekly is bullish. But for a day trader, as long as you have a good daily and a good intraday, it works. Now, 4-hour chart, check it out. This is a lot of consolidation because you look at the 4-hour time frame, right? It's been all just sideways consolidation. And it broke the trend line, but it did not really break the consolidation, right? And on a 1-hour chart, this trader has a trend line drawn in. Trend line could have been adjusted a little bit, right? But what he does not have drawn in is the support for the consolidation, okay? Which the support would have been 1 rejection here, 2nd rejection, 3rd rejection, 4th rejection with a bullish engulfing, right? And a 1-hour chart in general is also consolidating, and that's when the trade short was taken. 1-hour bullish engulfing, 4-hour chart was making bullish engulfing, and he missed analysis here, which was the range, drawing in the range, right? And instead it continued to go within that range, right? So that was a little bit of an IBO that is not very precise and is missing one major negative confluence factor, which is the support of the ranging, the consolidation, right? And that's kind of what I pointed out here. And he confirmed it. Weak break and retest, which it was, right? And lots of intraday indecision, and there was a range. Euro Azie short IBO-A, okay, May 3rd. In general, clean intraday price action, but a weak rejection of the daily resistance, as this is a pullback play. A better daily rejection of horizontal resistance would be preferred, not the daily highs. So another pullback, right, with a weak rejection of daily resistance. Let's have a look and check it out. So we have this daily resistance, we have this zone. It's a pretty good zone, right? You can see that this is a daily range in general. And it's, check it out, every single time price action rejected the zone, right? If it was here, it would act as support, right? It fully rejected the complete zone. If it was here acting as resistance, it rejected it fully again. Over here, full kind of rejection. Whereas this right here is literally like a little tap, right? Whereas every other rejection was more of a complete rejection of that resistance level, not just a small little top, right? So that's kind of what I meant by weak rejection of daily resistance, right? So this is a pullback play. A better daily rejection for horizontal resistance will be preferred. Note the daily highs. So I said note the daily highs. I mean, these are the daily highs. So if we were rejecting more of the daily highs, more of the top of the range, in my opinion, that would have been a better rejection. Remember, if you're a day trader taking day trades, quick opportunities, you want to make sure that you are rejection. You have a good daily chart, right? Good daily chart, good lower time frames. The higher time frames you take into consideration to see whether it was more of a quick opportunity or something that you can push a little bit farther. That's what you gauge by the daily trend or the higher time frame momentum on the weekly or the monthly, right? But if it's a daily pullback, either way, you want to have a good daily rejection. Cannot be weak, right? And then the 1 hour chart, I think the 1 hour chart was good. I mean, the 4 hour chart decelerated, nice reversal candlesticks, nice momentum to the downside, bearish MACD. 1 hour chart had a triangle breakdown, came back for a retest and kind of like a weak 5-minute breakdown, right? And then it just exploded. So this looks like it was news, right? Something else to dig into and make sure this definitely looks like a news. So make sure you don't have any kind of major news announcements. Specifically, make sure you're not trading through major news announcements if you do not have a perfect setup, okay? Meaning a full kind of rejection. If this had a full rejection and this lower time frame, this 1 hour chart, I think it would have been pretty good, right? And at that point, you can potentially take a risk of trading through major news. But if you don't have that full rejection on a higher time frame and there's major news coming up, then that's a potential issue. And then second point, this was also a 3% loss due to slippage over the weekend. Okay, so it was over the weekend. Get in a habit of checking if there are any major news events scheduled over the weekend. However, understand that sometimes you just can't avoid slippage as it can be unexpected with no news scheduled, right? So it could have just been one of those things. Something to note, this is, again, just something to keep in mind, this last point that I mentioned, right? The major thing here is make sure the daily chart is actually fully rejecting your resistance, not just barely topping it, okay? So that's good. That is Euro Azie. Let's quickly go through these last few. So Aussie dollar short ABO. So this is an ABO continuation on a daily chart, right? So let's take a look at these points. Okay. So continuation on a daily chart. This is a continuation play on the daily. If you're taking the daily continuation plays, know that they can be pushed farther than the 4-hour 50 EMA. Right? So if it's a daily continuation, you can push it farther than the 4-hour 50. If it's like a daily trend, daily wave 1, daily wave 3 specifically, or daily wave 5, if it's like a daily IBO or a daily CBO, you could push it farther. You could take an ABO and push it past the 4-hour 50. Or if you want to be strictly a day trader, any ABO, you can just target the 4-hour 50 EMA period, right? That would be more of a hybrid approach. The main issue is the lack of deceleration on the daily and deceleration within the intraday price action, okay? Triangles within ABO setups happen at the end of the 1-hour trend, right? So this is, again, a lesson coming up again. Triangles within ABO setups happen at the end of the 1-hour trend. They are not dead trend, right? But typically occur at the end of the trend, such as wave 5. So a wedge should not be the complete trend, right? So this is another example of that. It should not be the complete trend. It should only be happening at the last stages of that trend, okay? Wave 5. In this case, you drew the triangle as an entire bullish move on the 1-hour chart. Check it out, right? So entire bullish move on the 1-hour chart. The entire bullish trend is the triangle. In my opinion, that is incorrect, right? Deceleration would give you a triangle pattern at the end of the 1-hour bullish move. So the trade was taken right here, right? The daily chart, this is a higher time frame now. The daily time frame was in a pullback and it came to the daily 50 EMA and the trade was taken just as it rejected the daily 50 EMA, we didn't have any deceleration on that daily chart. Typically, if you have deceleration, you might have about 2 days, 3 days of deceleration on a daily chart. What that would give you now, that daily deceleration would give you more of a wedge developing on the 1 hour time frame at the end of the trend, right? So the deceleration on a daily chart develops some kind of a pattern on a lower time frame. In this case, you notice that the 1 hour double top developed after your entry. That would have been a more appropriate time to enter, as at least you have some price action deceleration and double top, right? So in this case, it was just a 4 hour pullback, right? So kind of like the 4 hour chart, check it out. 4 hour chart broke out, maybe rejected, kind of like a breakout, retest, big bearish run or big bullish run, and you're looking to take that pullback. Well, this could be just a wave 1, wave 2, wave 3, wave 4, now potentially finishing wave 5. It might decelerate and then continue further down, right? So this is just kind of playing this 4 hour pullback. So on a 1 hour time frame, same thing. We didn't really have much of a pattern. So it was taken after the 1 hour, 4 hour high test. So it was just taken because of the high test rejecting the daily 50. Here, after, once it developed more of a double top, then that could have been a better entry. Still wouldn't really give you a wedge. It would have given you a little bit of a wedge, right? Kind of a triangle pattern. That would have been a better entry. In this case, price fell, never really reached that 4 hour 50 EMA, and the trade moved the stop to break even and was taken out for break even. So I think moving the stop to break even was a good choice. As price action broke the 1 hour 50 EMA, you can remove your risk on the ABO. I think that was a good decision. It was just stopped out here for break even. Let's see if I have any other notes on this. Yeah, that's it. So again, the main note is wait for a little bit better of a rejection, and make sure you have deceleration, and make sure you have some kind of a price action pattern when you're executing those ABOs, right? So you see, we already have a few lessons on those ABOs that we started to identify, right? As we start to continue going through this journal review. So that was just another one. Make sure it decelerates, make sure it creates a pattern. Panazi long, IBO-B. When you have strong higher time frame support and resistance and a matching bias on the weekly daily, consider taking the daily pullback to around the 20 EMA region. Okay, so in this case, it was a daily pullback, and you have like support on a month, on a daily, support on a weekly. So you could potentially push it a little bit farther up, right? Potentially. So you have like major support, major weekly support. It's not fully being rejected though. This matches your own ASR notes on this trade. This is only for daily pullbacks with higher time frame momentum or support and resistance. In this case, consider short-term aggressive management, right? So this guy's a day trader, remember that. So if you have more of a higher time frame support, more of a higher time frame rejection, I think the rejections could have still been a little bit better, right? But you could have pushed it a little bit farther. So daily chart, good support, 1 hour time frame, really good. Overall good IBO. See, this trader's more of in a habit of drawing like a complete channel. So this is more of a channel rather than like a large wedge. It's just a general channel. Now here it developed a triangle pattern. So broke out of that triangle pattern, came back for a higher low, an IBO trade. The trade was executed, targeting the 4 hour 50 for a 1-to-1. In general, good, right? But sometimes you can push it a little bit farther if you have like major support on a higher time frames and major rejection. In this case, I think a 1-to-1 is good. I think if you wanted to push it, you potentially could have, but you can definitely push when the weekly chart is more on your side, kind of thing. So this is more of kind of something to keep at the back of your mind. It is not the perfect example of higher time frame being in your favor, right? All right, Azie CAD short ABO, June 2019. Oh, this guy's got a lot of notes. All right, so good ABO short. Let's have a look at it. Okay, so check it out. It was a nice 4%. Looks like short-term management was used a little bit incorrectly here. So let's break it down. Let's read the notes all together. So actually, let's have a quick look at the setup here, just in general. So daily chart, you can see it had a nice pullback, to the daily 50 EMA, kind of rejected it, started to fall down. So you can see it didn't have that much rejection on a daily time frame, had like a little doji, but hopefully the intraday chart's a little bit better. But in general, good kind of resistance area, daily 50 and so on. If you drew in your Fibonacci retracement from the high to the low, it would also probably be 0.32 Fibonacci. On a weekly chart, it's a break and retest of resistance, right? So that's good. In a monthly chart's no bias in general. So that's the higher time frames, playing that daily continuation. On a lower time frame, we can see that's an advanced breakout. Wedge is much better than the other wedges, and was taken as the bearish engulfing started to come in after about 5 hours worth of deceleration. Okay, so let's have a look at the notes and see what there is to say about this one. So agree with your own notes here in regards to bulletproofing behind the 1 hour 50 EMA. Be a bit looser and not so tight. We want to be closed out on a clear break above or below that 1 hour 50 EMA on short-term management. Okay, so let's have a look at, so this is what I meant here, right? He was using short-term management trailing that 1 hour 50 EMA, but it didn't even break, right? It didn't break that 1 hour 50 EMA and he got stopped up, or he closed the position. So you got to be a little bit looser. You cannot be very tight, because what if it just forms a high test and continues in your favor, right? So let's go back. So his notes, this trade was mismanaged on a 1 hour, on a 1A setup. So this is something different. You should manage from the 4 hour chart, waiting for a break of the 4 hour 50 EMA before exiting, since there's so much potential from a daily perspective of the trade being at the beginning of the daily trend. Okay. It does not have to be managed on a 4 hour chart, okay, period. You do not have to manage on 4 hour time frames. That can be a choice that you make, that whenever you take a swing position, you manage it on a 4 hour chart. But this trader is a day trader, right? So he does not necessarily even need to use the 4 hour management. He can just stick to a 1 hour 50, short-term management. If I had managed this trade from the 4 hour chart, it would have closed out for 5.7% and hit my original profit target. Good, right? Another mistake I made was bulletproofing too tightly behind the 1 hour 50 EMA. Okay, right? So this 4 hour 50 EMA management is not necessarily a mistake, right? Sure, it could have went on to bank a little bit more profit, 5.7%. But there are setups that you can manage with short-term management that go on to also bank 10%, 11%, 14%. We have examples of those, where you just only use short-term management and you make more profit with short-term management than you would with long-term management. That will happen, and it does happen quite often. But at the same time, you can also, if you commit to long-term management, managing on the 4 hour chart, and you commit to that, then there will be times where 4 hour management gives you a better return than short-term management, and vice versa. So you can see that you just got to commit to one. It's not necessarily a mistake that the trader did not use 4 hour management, right? He's a day trader. He should not have to be using long-term management as a swing trader would, right? You can, as a day trader, you can use 1 hour management, period, move on, right? So in my opinion, that's not really a mistake. If it happens once, it's not really a mistake. If you notice that you have taken so many positions, maybe you've taken 10 positions, and you have 10 examples where if you manage based on the 4 hour 50 EMA, you would have made 20% more in total, right? If you use 4 hour management. At that point, you can decide to switch and use 4 hour management, right? If you have a collection of a lot of data, multiple trades, telling you that yes, 4 hour management works better in your case. You cannot make that decision off of one position, right? Because a lot of times 1 hour management is better than 4 hour management, and sometimes 4 hour management is better than 1 hour management. Commit to one, or make a plan when to use both, right? But it's not a mistake. Another mistake I made was bulletproofing too tightly behind the 1 hour 50 EMA. That is a mistake, right? I should have bulletproof behind the 1 hour 50 EMA anyways, due to this being a 1 hour A setup, but even though I did, so he's saying he's going back to his management, right? Saying that it should have been the 4 hour 50 management instead. But if I did use the 1 hour 50 EMA, it should give more room to breathe, right? Period. So I agree, right? So I agree with that. I don't agree that it shouldn't necessarily be managed on the 4 hour 50, because this guy's a day trader. He prefers more short-term management, more of a day trader personality. That's who he is, right? He likes that. But in this case, he noticed that if he used 4 hour management, he would have made over 5%, not 4. Okay? That is a potential tweak if you have a large data sample telling you that 4 hour management will work better in your case. And you missed out about 20% of profit because you use short-term management instead of 4 hour 50 management. If you have data that tells you that, at that point you can switch to 4 hour 50 management. But if you don't have data and it's just one example, the next trade you take, the 1 hour 50 management might have been better than 4 hour 50 management. And again, we have many examples of that. So you will just be going back and forth. If you keep on flipping because one trade 4 hour 50 would have been better, and you switch your management to 4 hour 50 the next time you do it, but actually 1 hour 50 could have been better in the second example. So pick one, right? Stick to one, trust your personality, right? That's my kind of lesson with that. And that's exactly what I said here. So own your style. No need to utilize long-term management approach if you prefer being more of a short-term trader, right? Period. If you prefer to be more of a short-term trader, if that is your personality, you don't have to use 4 hour management at all. Remember that, right? Unless you want to. With that said, on Holy Grail setups, you can consider closing 50% of your position and utilizing the short-term or short-term aggressive management style and managing the other 50% using long-term management approach. This is also an option, right? So if you're a day trader and you use more of a short-term management approach, but you believe it can go farther, so you can shut down 50%, right, on the break of the 1 hour 50, and can let the other 50% ride using the 4 hour 50. That is an option. You can put that into your trading plan as a hybrid kind of personality, hybrid management, right? That would be a tweak in management. That's something that you can do. It's a consideration, it's a suggestion. It can be part of your management rule, right? It does not have to be. You can also just choose, I'll either use long-term because I prefer to sit longer in positions. I like to let them play out. So 4 hour 50 might be what you prefer. If you prefer to be more quicker, more snappier with setups, short-term management is what you would probably prefer. You can choose one or the other. You can have a blend like this where you close 50% and then manage the other 50% later. Or you can have a totally different management approach where you start off using 4 hour 50 management. And if it starts accelerating, you can switch to 1 hour 50 management. Management is interesting because there's different ways to play with it. And we'll talk about those different ways when we actually go into the next module, the next section, where we start building trading plans, right? But I just wanted to point it out because a lot of times people, traders, point out mistakes are not necessarily mistakes, right? And you beat yourself up for it and it's not really a mistake, right? Remember, lots of data, collect the information, and then make your decision afterwards. Yeah, so again, just the main lesson here for 1 hour management, keep your stop a little bit higher. If you're trailing your stop loss, right, keep it higher. If you're managing on a 1 hour 50 EMA break, again, make sure it's a clear break before you shut it down. Either way, 4%, really nice trade. That's exactly what we want. We want this trader to take more positions like this for 4%. You know, that's the one thing that he was lacking. Everything else is really quick and short and snappy, right? He was missing these setups that are with the daily run. He was just missing them, right? He didn't execute enough of them, and when he definitely could have. Is there anything else to say about this setup? Nothing else to mention. All right, so that is it for Azie CAD. We're finishing off here. 2 more, Azie Swiss, short CBO. And yeah, so let's dig into this. Okay. Slight targeting issue here. You also mentioned this in your review. Since this was a continuation of the daily trend, this CBO could have been pushed down to the daily lows for much larger reward risk ratio. Trade ended up being a loss. Either way, it ended up being a loss, potentially could have been pushed farther. Let's break it down. So if we look at the higher time frames, right? What we have here is the monthly chart. It's kind of at support, right? Well, it is at support. The weekly time frame, however, it just kind of broke down out of a pattern. This is kind of like a symmetrical wedge, right? Or triangle, it broke out of that and was kind of coming back to retest the support levels. The daily chart rejected those support levels, decelerated, formed a bearish engulfing, right? The one negative for a higher time frame is that we're at all-time monthly lows, but we could still go farther down to the bottom of the wicks, right? Which is kind of like the overall long-term support. Either way, this is a continuation of the daily trend. Weekly chart trend is bearish, it's just in this weekly pullback. But the daily chart again decelerated for 5 days and formed a bearish engulfing. So in my opinion, it's good. And then from the lower time frame, it was a CBO. Nice breakdown, retest with a 4-hour 50, 1-hour chart, pulled back, started decelerating, rejecting that 1-hour 50 and the 4-hour 50 at the exact same time. Great candlestick formation, high test, bearish engulfing, momentum, 5-minute break, great execution. Target was a 1-to-1, it was missed, right? And he was stopped out for 1% loss, okay? So that is fine. The trade would have been a loss anyway. The thing that I said here is that since this was a daily continuation, this CBO could have been pushed farther down. It would have been a loss anyway, but you could have pushed it potentially farther down, unless again this guy saw it. Monthly support, weekly charts kind of churning bullish, even though we don't have bullish price action, right? It's just pulling back to resistance. Then maybe that is why he chose to go more of a short-term target, but you could have pushed it further, right? And this is an example of increasing your reward risk ratio. It would have been a loss, but this is an example where you can increase your reward to risk ratio to be above 1-to-1. Azie CAD long ABO. So missing strong daily support level for an ABO, you mentioned this in your review. It's extremely important that you take ABOs from strong support and resistance levels. This is major key. This is mandatory. It is a must that you take advanced breakouts off of major support levels. Also, you're missing strong momentum and reversal candlestick on the 1 hour. This was lacking in that as you enter the position on a small 1 hour inside bar. Preferably you want a bit more bullish momentum at entry. This is also a must. It's a mandatory criteria for an ABO. Both mandatory criteria for ABOs are missing. You can see that in this case, actually we'll come back to that, but both mandatory criteria are missing. Major support, momentum, and candlestick formation. So check it out. Monthly chart obviously bearish, weekly chart obviously bearish. It's starting to accelerate here, right? A little bit. The weekly chart has this bearish engulfing, another big bearish candle. The daily chart, check it out, just in this big bearish run. Do we have deceleration? We do not, right? I don't even think there's major support. He drew in a level, but if you zoom out, there is no major support there. Then 1 hour chart is more of a wedge, right? Remember, he used to draw in the whole trend. This is more of an appropriate wedge. 4 hour chart definitely needs a pullback, so I see a 4 hour low test. And 1 hour chart had this tweezer bottom here, right? So that could have been a better entry than this entry, right? But this entry just literally had a little kind of inside bar. That's about it. Slight little 5-minute 50 EMA break. So no major candlestick formation at the time of the entry, no major volume, no major breakout at the time of the entry. So to me, it is missing that major confluence factor. So missing the strong daily support. In this case, the weekly chart is also accelerating. There's no deceleration here, right? And missing strong momentum and reversal candlestick on the lower time frame, right? We need that momentum. We need that strong reversal candlestick. Those two things are key. They're major. So what do we got here, right? We went through every single one of those trades. Now, I didn't review every single position because there were over 40. I just reviewed the ones that actually have the lessons, right? Other ones are good. Other trades are good. Nothing to worry about. They don't need to be in this review. They're good. Nothing to worry about. But all these trades had some kind of lessons, and you notice that ABOs, 1, 2, 3, 4, 5, 6 ABOs, pretty much all of those could have been avoided, right? And all of those have very similar lessons, and we're going to be digging into them here. Advanced breakout strategy, major lessons learned. Complete breakout strategy, major lessons learned. Management style, major lessons from there. And Elliott wave theory, major lessons from there. That is the second part of, or that is the third lesson actually, once we start digging into the major lessons. Right now, what we did is reviewed the trades. So we went on, reviewed the trade, there's the journal, the screenshots, dug into it, made some notes of some negative confluence factors, some tips, things to watch out for. So I hope you guys were listening and taking notes yourself as well, because a lot of those lessons that were within this journal review, if you wrote them down, chances are you'll find them in your own journal review as well when you go through that, right? So that is how you do it. You just go trade by trade, look at the screenshot, right? And kind of with a clear eye, you don't have to look at your previous analysis. You don't have to read your previous analysis. And I would suggest you read your analysis or your review notes after the fact. Start off simply looking at the screenshot. What do I have, right? And based on my current knowledge, what can be improved? So you spend some time looking at the screenshots for the higher time frames, the lower time frames, break them down, find some lessons, find some negative confluence factors, write them down, and all of a sudden you might notice things that are repeating. Just like we noticed here within this journal review, there were things that were repeating with the ABOs and so on, right? And those are the things that can be changed and that should be changed, that pretty much have to be changed, because they're repeating lessons that are causing losses. And right away, this trader can take those lessons, apply them, right? Backtest his trading performance, and he will notice that it's not 18% anymore, which his year-to-date return for 2019 was 18%. You remove these setups, you improve based on these lessons, and all of a sudden that 18% will be more, because you take out about 6 losses from ABOs, that is minus 6%. So now that 18% is about 6% higher, right? And that's how you make small little tweaks. And then you make them into actual major lessons, right? And once they become major lessons, I mean, you do not repeat them. That's the major thing. You do not repeat them. There are a bunch of small little lessons within there, tips, insights. It's the repeating lessons that you get to eliminate, right? The other things you just keep at the back of your mind. And if you start seeing a pattern, adapt when you eliminate, right? That is it for this lesson. I hope you guys enjoyed it. So we looked at the journal review, the actual data collection, pulled some information out of there. We noticed that advanced breakouts have a very low strike rate. So we dug deep into advanced breakouts here, and we could have actually removed 6 of them. And all 6 of them pretty much had a very similar lesson, right? So we're going to look at those in the next lesson as well. We're going to look at what were those ABO lessons. We also noticed CBOs weren't executed too much. We didn't see many CBOs. So what this trader can do now is backtest 2019 and see how many CBOs he has missed. Because obviously we cannot review any CBOs here, but we noticed within the data collection that he only took like 6 CBOs, and that is the most profitable strategy with the highest strike rate, typically, the most confluence factors. So what you do now, the next process for this trader would be spend some time backtesting 2019, see what he has missed, right? And so on. So we're going to be digging into those major lessons in the next lesson, but that is how you do a journal review. Start off with the data collection, then you continue going trade by trade, screenshot by screenshot, taking notes. And as you are taking those notes, all of a sudden you will start seeing repeating patterns. And those repeating patterns are the lessons that are major key. That is it for this lesson. I'll see you in the next one. Take care.